I'm going to talk a little bit about Autodesk. I know we talked about it yesterday. The stock was down some 7% or so today. Let me see what, at one point it was down 10%. And let's see. Oh, the market is closed. So wow, it finished the day down a little more than 9%. So let's run through some of the things that may have made people nervous, and we'll kind of talk through that. Let me share my desktop here. So we'll jump to, so here was the slides that we were looking at yesterday, just to level set folks. The revenue came in, this was from last quarter. So management outlooks last quarter that they were going to do between 1.0 and almost 1.1 billion in revenue. And look at this, they matched the high end of the range of guidance, which was a 16% year over year increase. Interestingly enough, when you read through the conference call and the 10Q, it's a 14%. CN is currency neutral. I could have run off the screen. So currency neutral. So currency, they had some currency headwinds to about the tune of 2% on the top line. EPS, generally accepted accounting principles, which means just the way you're supposed to, is they were a beat. And even on the non-GAAP, when they pull out one-time expenses and stock-based compensation, it was a beat. So why is the stock down? Well, let's keep looking. So the full year outlook here on the left is last quarter's full year outlook, and here on the right is this quarter's outlook. And I had some little smiley faces and frowny faces. So billings, you can see the top end of the range slightly decreased, as well as the bottom end of the range decreased. And so they narrowed the range, which you would expect as the quarter goes, as the quarters go on, you get closer to the end of the year. Remember, this is a full year billings number, or how they're going to end the year. And then they reduced it. Revenue, they upped the lower end. This is very kind of strange. So you can see this 4385 is the same number on the high end, but they up the lower end, which means they have a little more confidence in the quarter. And you can see it's, instead of 14 to 16%, it's up 15 to 16%. These are about the same. And on the earnings, they up the entire range, both on the EPS, the GAAP and the non-GAAP numbers. Now, here between the billings and the free cash flow are the things that they reduced. And you remember Trevor talking about remaining performance obligations and all this. So some of this billings and these free cash flows are forward looking and take into account multi-year contracts and things like that. So these are indicators of future business, and this range was reduced, and it was reduced below the bottom end. You can see now the high end is 1575, where that was the low end before. So I think that's what disappointed the market, disappointed investors, and why they're selling the stock off slightly. Let's just look at Q3, and then I'll back up and I'll share a little bit of stuff from the conference call. So Q3, analysts expected this wide range. They came in a little lower. It's in the middle of the range. I don't think that fretted anybody. And then analysts had this really wide expectation again for this earnings per share non-GAAP, and the average, they hit about the average. So this it's not really a revenue statement for next quarter or an earnings statement. It's really this sort of billings and future cash flows kind of concern. So when you go to the let me go to the earnings call. So one of the things that the company talked about is they've been seeing good trends in the market that have moved to reopening. They talked about China, Korea, Japan, product renewal rates are all trending in the right direction. The pipelines are very strong, but they said there's still a fair amount of uncertainty, particularly in the US and UK. So basically what they said is, and this is a CFO, as we weigh all the combination of those factors together, it gives us the confidence to raise the overall revenue target by 15 million at the midpoint. But we said the high end range, but we had said the high end of that guidance range was previously expecting more of a swift recovery. And so while they said they've seen that in some markets, they haven't seen it in all markets. And they've also, so there's a little bit of recovery stuff going on there. And let me mention here's the one other thing. So they've changed the way they go and deliver. They get paid for multi-year contracts, and this is coming out in the next quarter, which affects their billings and free cash flow targets. So for enterprise business agreements, which is these multi-year, large multi-million-dollar contracts, in the past, they've collected all of this money up front. That seems, for a 3-year thing, that seems like that's an undue burden potentially on the customers. So what they've done now, in order to get all that money up front, Autodesk would take future years and discount them and give them sort of a discount, sort of a cash up front kind of discount. Well, they've changed that. They've eliminated the discounts, and basically what they've said is, we want you to pay annually, but we're going to have this, multi-year contract. So it kind of throws this free cash flow thing and these billing things into a little bit of a tizzy. But to me, this is a pro customer kind of move, where customers now can more appropriately budget. I think it's an opportunity as well, and DocuSign does this super well, and I imagine Autodesk is also going to start to do this if they don't already, is have more conversations with these multi-year customers. So when the bill comes due, they can look and see how they've been using the cloud software, if their usage rate is running higher or whatever, and then they can go back and go, you know what? We need to rejigger the contract and, have another discussion about what you're using. And, maybe we can bundle it with some other software that we've come out with in the past year that we think you'll benefit from. So there's this kind of billings and free cash flow sort of depression that, when you just look at the numbers, can say, ooh, the future for Autodesk doesn't look as bright as it, has in the past. Well, it's really just an accounting change. And so, I saw Tim talking about Autodesk earlier today, and, he went through the report and said, there's absolutely nothing here that I like. I know John and I got the pleasure of talking to Jim Gillies last night. Jim loves Autodesk. I think this was a solid report, and I think this sell-off could be an opportunity to get the stock at a couple points better.
Yeah, Brian, you handled this really well, and I don't know this company very well, but let me give a layman's perspective here.
Yeah.
I was on the show with Brian Feraldi this morning. He was talking Autodesk, and he pointed out that even with the free cash flow disappointment, if you want to call it that, we're still north of 30% margins. And the top line is growing by double digits. That's a company that you rarely want to bet against when they're growing the top line quickly and the free cash flow margin is over 30%. For a company that their software is the gold standard, they still have millions of people who haven't converted from the legacy software. And then they have many more who are using it but not paying, and they're trying to get
Right.
those people to convert. It's still a major tailwind potentially if they can get those people to convert to the subscription.
Yeah. So, for Backstage members, this was announced. We're about a week and a day, or 2 weeks and a day now. I can't remember. The Autodesk was one of the, um, you know, 5 initial Backstage recs, and you can see why, as we've kind of talked it up today. So.